Happy Monday, everybody. Now, last week brought investors something we have not seen in several months. That was a powerful, broad market rebound. The Dow, S&P, and Nasdaq all recorded their best week since April. The rally was fueled by easing geopolitical concerns, generally positive corporate earnings, a major rebound in technology stocks, and believe it or not, a surprisingly weak jobs report. That jobs report was certainly not good news for the economy, but investors viewed it as reducing the likelihood that the Federal Reserve will raise interest rates anytime soon. Now, let's take a closer look at what happened last week. Stocks started the week sharply higher as President Trump called off planned military strikes against Iran, and hopes increased for renewed negotiations and a possible agreement involving the Straits of Hormuz. Now, oil prices, of course, from that fell sharply on that news, relieving some of the pressure on inflation and treasury yields. Investors also received a better than expected report on manufacturing sector, which helped reinforce the idea that the economy remains resilient. The rally was broad, but technology stocks led the way as investors returned to some of the areas that have been hit hardest during the previous month's sell-off. By Monday's close, the Dow was up 1.25%, S&P gained 1.5%, and the Nasdaq climbed 2.25%. Rally accelerated again on Tuesday. Strong earnings from several artificial intelligence-related companies helped ease concerns about whether the enormous amount of money being spent on AI infrastructure can eventually generate sufficient revenue. At the same time, job openings and factory orders came in slightly below expectation. That helped bring treasury yields down from their recent highs without creating immediately concerns about a major economic slowdown. Optimism also continued to build around a possible diplomatic agreement that could reopen shipping through the Strait of Hormuz. Oil prices fell again, removing another potential obstacle for stocks. The S&P 500 and Dow both reached record levels during the session, although some late-day profit-taking kept the markets just below its high. For Tuesday, the Dow gained 1.75%, S&P up 1.75%, and the Nasdaq up 2.5%. Stocks opened higher again on Wednesday, but the early rally faded as investors confronted a combination of mixed economic data, renewed geopolitical concerns, and additional questions surrounding technology spending. The services sector continued to expand, but the report's inflation component came in hotter than investors had hoped. Meanwhile, private sector employment data was disappointing. That creates an uncomfortable combination, signs that the labor market may be weakening while inflation remains stubborn. The Dow managed to reach another record close, but the technology-heavy Nasdaq fell as investors took some profits following enormous gains on Monday and Tuesday. At Wednesday's close, the Dow was up 0.5%, S&P slipped 0.25%, and the Nasdaq declined 0.75%. Markets remained under pressure on Thursday. Some technology earnings failed to meet investors' extremely high expectations, while economic reports showed that initial unemployment claims maintained low and announced layoffs had declined sharply. Those labor market numbers pointed to continued economic resilience, but they also briefly pushed treasury yields higher because of a stronger economy could make it more difficult for the Fed to justify lowering rates, or could eventually give them another reason to raise them. Investors were also waiting for firm details regarding that Strait of Hormuz. Conflicting reports about which countries would be permitted to use the waterway created renewed uncertainty, pushing oil prices and bond yields higher. For Thursday, the Dow fell 0.75%, S&P down 0.25%, and the Nasdaq was essentially flat. Then came Friday's highly anticipated July employment report, and it delivered a major surprise. The economy lost 23,000 jobs in July. Economists had expected the economy to add approximately 83,000 jobs. The unemployment rate actually declined from 4.2 to 4.1%, but that was largely because fewer people were participating in the labor force. Not good news either. Investors immediately concluded that the weak report made a near-term Fed rate hike much less likely. Treasury yields fell, technology stocks rallied, and the S&P closed at another record high. This is an important distinction. The market was not celebrating job losses. Investors were reacting to what the report could mean for interest rates. Excuse me, a weaker labor market may reduce inflationary pressures and give the Federal Reserve more reason to keep rates unchanged. But if employment continues to deteriorate, concerns about the economic growth could eventually outweigh the benefits of lower interest rates. For Friday, the Dow gained 1%, S&P rose 0.5%, and the Nasdaq climbed 1.25%. For the full week, the Dow was up 3%, the S&P rose about 3.5%, the Nasdaq surged to up over 5%. Technology was the strongest performing sector, gaining approximately 7% for the week. Materials and industrials also performed well, while energy stocks declined as oil prices fell. Bonds gained as treasury yields moved lower, and gold rose more than 7%. Oil finished the week down nearly 9% as investors became more optimistic that diplomatic efforts could restore at least some shipping through the Strait of Hormuz, We'll see how that worked out through over the weekend. So, what should we take away from all this? First, the technology rebound was significant. Strong earnings helped to ease some concerns about AI spending, but the valuations do remain high, and expectations are still extremely demanding. When expectations are that high, even good results may not always be good enough, as we've seen. Second, the Fed remains a major source of uncertainty. Several Fed heads have recently emphasized that inflation is still too high, while Friday's jobs report provided evidence that the labor market may be weakening. That leaves the Fed trying to balance two risks that may be moving in opposite directions. And third, geopolitical developments remain important. Lower oil prices helped stocks and bonds last week, but the situation surrounding Iran and the Strait of Hormuz remains fluid. Any renewed disruption could quickly push energy prices and inflation expectations higher. Looking ahead, today does not bring any major economic releases, so investors are going to stay focused on earnings, interest rates, and developments in the Middle East. Tomorrow, we start to receive eco data. Existing home sales will be tomorrow. Wednesday will bring most important report of the week, the July Consumer Price Index. Now, headline inflation is expected to rise approximately 0.1% for the month, with core inflation, excluding food and energy, expected to rise approximately 0.2%. On a year-over-year basis, headline inflation is expected to decline slightly to approximately 3.4%, while core inflation is expected to ease to approximately 2.5%. A cooler than expected number could reinforce the belief that the Fed can stay on hold. A hotter report, especially after last week's jobs data, could raise concerns about stagflation, where economic growth weakens while inflation remains elevated. We've seen and we've talked about that many times in the past. On Thursday, we will receive the Producer Price Index, which measures inflation at the wholesale level, along with the latest weekly unemployment claims. Producer prices are expected by some to rise approximately 0.4% for the month, which would be hotter than consensus estimate. That makes Thursday's report another potentially important test for inflation and interest rate expectations. Then on Friday, we're going to get July retail sales and the preliminary University of Michigan consumer sentiment report. Headline retail sales are expected to be approximately flat or slightly negative, partly because of lower gasoline prices, weaker auto sales, and the timing, believe it or not, of Amazon Prime Day, which was in June rather than July this year. Retail sales, excluding autos, gasoline, and building materials, are expected to rise approximately 0.2%. That will help show whether consumers are still spending as savings rates remain low and concerns about employment increase. Consumer sentiment is expected to remain near its current subdued level. Earnings season is beginning to wind down, but there's still some meaningful reports coming from technology, infrastructure, semiconductor equipment, restaurants, consumer brands, and some other economically sensitive businesses. And the Fed heads are relatively quiet this week. Hammack speaks today and again on Thursday, while Barkin speaks on Thursday. Investors will be listening closely for their views on Friday's surprisingly weak jobs report, the continuing inflation threat, and whether the Fed should keep rates unchanged or consider raising them later this year. The bottom line is last week's rally was impressive, but it did not eliminate the market's major uncertainties. Stocks are near record highs, technology valuations remain elevated, inflation is still above the Fed's target, and Friday's job report introduced a new question about the strength of the labor market. It does not mean investors should expect an immediate reversal. It does mean that after such a strong week, we should be prepared for continued volatility as markets determine whether slowing employment and easing inflation can coexist without causing a broader economic slowdown. As always, we're going to continue to focus on the long-term plans rather than reacting to any one jobs report, one inflation reading, one earnings announcement, or geopolitical headlines. Have a great week. We'll see you Friday and then again on next Monday.